Show The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures in the green amid the shortened trading week as investors digest the latest Fed speak and geopolitical risk. Fed Governor Chris Waller saying he supports holding rates steady as the central bank monitors for progress in its inflation battle. Investors will get the latest insight into the Fed when the meeting minutes are released tomorrow, Wednesday. Meanwhile, global stocks getting a boost today as Russian and U.S. officials, they meet to negotiate an end to the three-year war in Ukraine.
Plus, investors are awaiting earnings results from Walmart, Alibaba, and more this week. Tariffs and inflation are going to be in focus for Walmart City, expecting strong holiday sales to help the company beat estimates. And trade policies will also be in focus for Alibaba. The Chinese e-commerce giant will likely face some questions on the planned imposition of U.S. duties on small packages, as well as its guidance on artificial intelligence rollouts.
And a scary scene in Toronto on Monday as a regional Delta flight flipped out of control after landing in windy and freezing conditions. All 76 passengers and 4 crew members survived the crash, but 15 were injured. Delta CEO Ed Bastian says the company is working to confirm the details and will share the most current information on the incident as soon as it becomes available. The incident continues a bad start to the year for air safety in North America, shares of Delta dropping after the crash. Wall Street is feeling bullish according to the latest fund manager survey from Bank of America. Cash levels hit their lowest level since 2010 as equity investors rotate their holdings into bond-sensitive sectors. Joining us now, we've got Yahoo Finance's Josh Schaefer. Josh, there were some elements of this survey that remained a larger trend, but perhaps some new elements as well.
Yeah, Brad, I mean, interesting. So we've been talking about low cash levels in this survey for a while now, but for cash levels to fall to 3.5%, that's where they're seeing their allocation to cash, these fund managers. Lowest level we've seen in about 15 years. And really, guys, what that tells me is sort of the market action we've been talking about over the past couple of weeks, which is people want to keep their money in the market. People want to be in stocks right now, whether it be perhaps maybe different stocks, different sectors than we've been talking about over the last couple of years. But it seems like there's a clear bias here from investors to keep their money in the market, and that was one of the broader takeaways. Also another chart here, guys, pointing out that fund managers still see the Magnificent Seven trade as the most crowded trade. Again, when we think about the action over the last month and a half, if I think Mag 7's the most crowded trade, I'm probably going to put my money somewhere else. And that's been the market action that we've seen sort of to start this year, right? Has been people allocating in other areas, perhaps outside the Mag 7.
And then to that point, just in terms of the expectations, where they're expecting to see some of that outperformance too.
Yeah, so overall, some fund managers pointing out that they think they're going to see more outperformance outside of U.S. equities, which was pretty interesting, Shauna. So they pointed to global equities. They also pointed to gold. We know gold pushing higher this morning, right? Global equities have actually been outperforming the S&P 500, depending on what you look at. We're looking at a chart here of just the emerging markets ETF from BlackRock. You put that over the S&P 500. Emerging markets up about 6%, S&P 500 up about 4% to start this year. Seeing that trend a little bit this morning too. EEM outperforming a little bit compared to the broader market, at least in pre-market trading. But there's been a little bit of a shift here of, okay, European stocks are super undervalued. Most people would argue that. Maybe growth is a little bit better than expected there. Maybe that's an opportunity space when you think about the US and the economic narrative we're starting to look at here, which is, were we too bullish on overall economic growth going into this year? And does it come down a little bit? And U.S. stocks are overvalued, right? So it becomes a discussion of just where do I think I can get a better return? But there is sort of a growing case for maybe a little bit less Mag 7, a little bit more of the other U.S. equity space, and then also maybe there's some opportunity in the rest of the world here. You guys mentioned Alibaba earnings later this week, but that's a stock that's been really hot, and people have been talking a lot about China stocks too.
You mentioned the risk-on appetite here, which is clearly at play, and it shows through some of the charts that you've been running through. What type of perhaps risk does that also put on the table for the broader markets, especially as we're trying to figure out, all right, if 6,600 is perhaps one of the average consensuses that we're seeing out there, the chop that we would see en route to that 6,600 S&P 500 target as well.
Yeah, this is something we've been talking to strategists about too, Brad. We're talking about people want to stay in the market, but there's a lot of money moving around into different areas. So if you don't have sort of that Mag 7 leadership, maybe that's why you don't get your 20% return in the S&P 500, right? There's a lot of stocks outperforming the index right now. There's almost half of the index is outperforming. The companies within it are outperforming the index. But there's different names, right? And they're smaller names. They're not your large names. So you're starting to see a little bit of a shift in terms of where the outperformance is coming from. And I guess to put it as they like to say it, it is a little bit of a stock picker's market right now. So if you're into that, there's some opportunity out there for once, which we haven't seen over the last 2 years.
Yeah, and Josh, just going back to what you were saying a moment ago, just in terms of some of the catalysts that investors do see on the horizon, and this really speaks to the fact that some of that leadership may be coming from outside the Mag 7, even outside of U.S. equities. But in addition to China, we talked about in second place, or the second biggest driver maybe, is AI productivity, right? And then the third is the Fed cut. It's just interesting to see just in terms of where the Fed now sits in the overall macro investment theme, and very much just in terms of the fact that we've been talking to strategists day in and day out, and they're saying just in terms of the fact that the Fed isn't expected to cut too much this year, just one cut maybe before the end of the year, potentially even for no cuts. It's not so much of a concern maybe for the markets as we initially would have thought going into this year.
Yeah, no, and we've priced out, so we went from 2 cuts. We basically priced out one of those cuts last week, sort of teetering between 1 and 2 right now, but the market hasn't been overly shook by that, right? Stocks have been pretty resilient through each piece of data. You guys mentioned Fed minutes coming out tomorrow in a pretty quiet economic week. That will be one of the bigger releases of the week. And I think the key question for the Fed minutes and for the market will have from Fed minutes is, does the Fed still have an easing bias? Right now, we are under this impression that if the Fed were to move in 2025, it would be reducing rates. There is not a lot of discussion that their next move would be a hike. As long as there's an easing bias, that's part of your bull case for stocks, and that's why stocks have done okay. If we start to think, they're really worried about the tariff story, and they're really worried about where inflation could head at the end of 2025, and there's real debate about hikes, that's when I think Fed might be a higher risk on it. It comes up from number 3 to maybe number 2, number 1, because rates staying here might be okay. Rates going higher, that's a different story.
Certainly. All right, Josh, great stuff. Thanks so much for breaking that down. Well, while investors are showing a greater willingness to take on risk, our next guest is warning that the U.S. bull market is due for a pause. Joining us now, we want to bring in Chris Watling. He's a Longview Economics global economist and chief market strategist. So, Chris, talk to us just about the fact that why you think the U.S. bull market is due for a pause.
I mean, well, multiple reasons, but primarily, I mean, the bull market in the States rarely goes more than 2.25 years without a big break. I mean, it doesn't have to be a bear market, but certainly a big break, a multi-month pullback. Maybe it's 10%, maybe it's a little bit more than that. And you can see that if you look at the history of the S&P 500 all the way back to the 1970s, it almost never goes longer than that without a meaningful crack. And you can see the signs of it. It looks tired. I mean, as we were just hearing, there's been rotation away from US equities. Other parts of the world are doing a lot better this year. And also it looks to us that not only is the bull market looking tired from a technical perspective, but I think the US economy is going to struggle in the first half of this year. The sort of enthusiasm about the US is really widespread and strong coming into this year. But actually, when I look at Trump's economic agenda and the way he's playing it and the order of that agenda, I think it's going to be negative for growth in the first sort of part of that agenda, perhaps first half of this year, maybe first 3 quarters, and then it gets much better for growth going on out. So I think there's a bit of a growth issue in the US relative to expectations. It's going to be softer. I mean, I emphasize the relative because, of course, growth, it will still be there. And then the bull market looks tired. It needs a break, and we're getting sector rotation globally that doesn't favor the US large cap. So it's kind of a mixture of technical factors and macro factors that are concerning us at this juncture.
Yeah, you mentioned some of the pressures that could be induced because of policy, but then on the backside of that, on the rebound, would it just be relief that perhaps the policy that's talked about, perhaps beginning as negotiation and then starts to get into actually how it plays out and perhaps backing off of some of the worst extents of that negotiation, that it's just relief that it's not as bad as it could have been, and then we start to get more clarity around how companies could operate in that macro?
Well, we're certainly going backwards and forwards on tariff debates, and no one really knows exactly where we're going to land on that. Although I have to say, I still think that the playbook's pretty clear for Trump and his team, and it's been written down in a number of places. And the tariffs playbook is simply one, part of it's transactional, perhaps with more of the allies, and part of it is raising revenues and creating a fair international trading environment. But there's more to it than that. I mean, the reality is Trump's got to create fiscal space to do tax cuts, which means they have to cut on the fiscal side up front, cutting government spending, as we're seeing with Musk's Doge. And in fact, this is already happening. As of day one from Trump's new presidency, the cutting began and the freeze on government hiring began. And in fact, if you look at last year, about 70 or 80% of non-farm payroll job growth in 2024 was either direct government or indirectly related to the government. So, the private sector isn't creating as many jobs as it normally does. The labor market's quite soft. The economy's been driven by fiscal strength under Biden, and that fiscal surge and that fiscal stimulus is going away, at least temporarily. So I think that's the point. Tariffs is clearly a negative, but also that fiscal support is no longer going to be there for the US economy in the first sort of half, 3 quarters of this year. And that I think is where the economy starts to struggle, because under the surface, the housing, the manufacturing, they're all quite weak, and they're manifesting the effects of tight money. And so I think we need more monetary support for this economy in the US in 2025, because we're going to get less fiscal support, is really the net. And tariffs, of course, add to the disruption on top of that. So that's kind of how we're seeing it. There are some challenges relative to expectations for US growth, I think, in the near term.
So, Kristen, given that, where is the opportunity?
Well, the opportunity is overseas because, we're in a global rate cutting cycle. Now, I know that, we priced out a lot of the cuts in the States, but the rest of the world is still cutting rates. And I think the US will come back to the party if we get this soft patch in growth. So we're looking for a cyclical upswing later this year. And I think that's what the market is starting to think about as it rotates to Europe. And in fact, it's rotating a little bit to Asia as well. I mean, part of the Asian story is the sort of tech, Chinese tech deep seek story. But part of it is rate cuts, and particularly in Europe. You look at the banking sector, the banks have done remarkably well. If you look at the southern European economies, they're doing terrifically. Their stock markets, the Italian stock market keeps making new highs. So does the Spanish market this year. So it's not always one-way traffic to the States. At the end of last year, everyone thought it was American exceptionalism and all that. And the Mag 7, of course, they've had a terrific run. But as I said, I think when I came on your show August last year, every man and his dog owned Nvidia back in August last year, and Nvidia's done nothing since then. Neither's Microsoft. So, the world is rotating. The opportunity is in cyclical spaces over the next sort of 6, 12, 18 months. So I think the market's getting the sort of sniff of this, and it's starting to rotate, and we're starting to unwind those extremes in positioning that favored the US at the back end of last year, and everyone disliking Europe, for example, at the back end of last year. That's starting to change.
Yeah, some people have even named their dogs after Nvidia. Lastly, while we have you here, Mag 7, as you were talking about where we could see opportunity for investors to either take profits right now or just lock into that trade long term, if they were to take profits at this juncture, where do you think some of that money gets reinfused back into the market?
Well, I think mid and small caps in the States can do well. They're going to enjoy the deregulatory environment as it comes about. They're not going to enjoy the initial cuts in government spending, but they're going to enjoy the lower interest rates. I think you're going to start getting a credit cycle in the US later this year. The deregulation agenda, all of that helps small business sector. And along with that, home builders as well. So I think small and mid caps plays on domestic economy outside of the large caps will do well. So we like that. We like the cyclical areas of the market. And I mean, of course, you've got to go over this pullback in the US that we think is coming over the first half of this year. But I would use that pullback to reallocate money to as I say, the small mid caps, the cyclical areas of the market, and maybe even some of the deeper cyclicals as the market sells off. But certainly the sort of classic consumer cyclicals, home builders and so on, I think will do well as we price back in rate cuts into the US curve and as the US large cap market comes off and sets us up for a cyclical recovery in the second half of the year.
Chris, thanks so much for taking the time.
Thank you.
An update on a developing story in Canada. A Delta Airlines jet landing at Toronto's Pearson Airport crashed into the tarmac and flipped onto its roof on Monday afternoon. The flight taking off from Minnesota arrived in Toronto around 2:45 p.m. Eastern Time amid blowing snow, strong winds reaching 40 miles per hour on the ground. All 80 people on board the flight, 76 passengers and 4 crew, were evacuated and survived the incident. 18 people were injured and taken to the hospital, with none believed to be in life-threatening condition. Canada's Transportation Safety Board is leading an investigation, with the U.S.'s National Transportation Safety Board putting together a team to assist. The cause of the crash is not yet clear, according to officials. Toronto Pearson's fire chief gave this update after the accident.
This is an active investigation. It's very early on. It's really important that we do not speculate. What we can say is the runway was dry and there was no crosswind conditions.
Delta Airlines CEO Ed Bastian released a statement saying, quote, "The hearts of the entire global Delta family are with those affected by today's incident at Toronto Pearson International Airport." This was the 4th major aviation accident in North America this year.
All right, coming up next on Morning Brief, we're going to count you down to the opening bell on Wall Street with stocks set to open in the green. Plus, we'll check in on shares of Southwest, the company planning to lay off about 15% of its corporate workforce. And we get a preview of what to expect from Walmart results as the retailer reports later on this week. We'll discuss that and much more coming up next.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Southwest, cutting 15% of its workforce in its first ever mass layoff as the airline continues to cut costs. The company expects the cuts to save $210 million this year, $300 million in 2026. And the cuts will affect about 1,750 jobs, including some senior leadership roles. We've been keeping tabs on shares of LUV. They are up right now. This is typical in terms of the stock reaction that you see when some of these corporate-wide restructurings and layoffs are actually rolled out here. Some of this had started to already be communicated by Southwest and how it was looking across its entire cost basis here. And then you also think about some of the activist pressure that certainly has elicited some of these actions too.
Yeah, it certainly has been a year of change, I think it's safe to say, for Southwest, just given the fact that they had the involvement from Elliott Management, given the changes that we've seen to their board, given the changes that we've even seen to some of the structure there of their business in terms of their offerings. They're going to start offering premium seats, more leg rooms. They started red-eye flights. Certainly a number of changes being enacted in Southwest. But the reason why this is such a big deal is because this is the first mass layoff that has been announced at Southwest. So given the significance of that, given the fact that it's 15% of corporate positions, including senior leadership and directors' role, really just shows, I think, some of the pressure that Southwest has been under, continues to be under, in order to turn around the business. They are doing everything they can to cut costs. We've talked to CEO Bob Jordan a number of times about this. He released this statement saying that we are at a pivotal moment as we transform Southwest Airlines into a leaner, faster, and more agile organization. He has talked about that time and time again to us here at the desk at Yahoo Finance following earnings results, most recently there from Southwest a few weeks ago. So again, they are making improvement. They are making some steps. They have taken some steps in the right direction. But again, when you take a look at the stock performance and stack it up against some of their bigger competitors within the space, clearly they have still underperformed and more changes are needed at this point.
Yeah, absolutely. You can see even more of the details in the SEC filing from Southwest this morning here. But again, we'll be tracking shares in reaction to this throughout the rest of today's trading session.
All right, let's take a look at a couple of chip makers. Broadcom and Taiwan Semiconductor reportedly considering deals with Intel that would split the chip maker's business. This is according to a report out from the Wall Street Journal. Now, Broadcom has interest in Intel's chip design business, while TSMC is looking at the company's factories. The talks are in preliminary stages. You're looking at share reaction. Intel off the highs here of the morning, now up just about 4% here in pre-market trading. You have Broadcom just below the flat line. You have TSMC here up nearly 1% ahead of the open. I was taking a look at some of the initial reaction there from the street. Cantor Fitzgerald coming out saying that the clear strategic winner here in this is TSMC. The company might become the sole leading edge foundry provider worldwide. So they're seeing that as a big takeaway here from this report. And again, Needham also saying that Intel Foundry is operating at a huge loss and would likely not have a buyer if TSMC does not step in. There's lots of questions about who potentially would be interested if this, in fact, was a route that Intel were to seek. And again, we are seeing some reaction here in shares ahead of the open with Intel up just about 4%.
Yeah, the larger question here, too, for me is when you think about what the Trump administration has already said in its own stances about advancing American businesses, and especially with the broader reliance that's already been made known and well documented on TSMC and their fabrication and wafer production as well here. The question of what TSMC would have to go through in order to get this regulatorily approved in this administration right now, even as we talk about some of the deregulation and deal making that was bolstered coming into the election and then thereafter, as Trump was looked at as a pro-business president. Ultimately here, I think, with the reactions that we've seen from the Trump administration and what they would potentially support and not support, TSMC getting this factory and manufacturing footprint of Intel, which had already been earmarked for billions of dollars from the government to bring a lot of these factories online. I think that's very much up in the air, and we would have to see exactly if this is one of those deals that would still get the kind of, the seal of approval going forward. But that's one of the larger implications for me, at least thinking about the billions of dollars that Intel had been essentially guaranteed to build up its own factory production too. Mm-hmm. Also here, let's talk about Baidu. This has been an interesting one to track here pre-market. Shares of Baidu, they are lower right now. At least they were by about 4% earlier, and they are right now, reporting a smaller than expected drop in the fourth quarter in that revenue, and the Chinese tech giant doubling its profit as its AI business offsets weak advertising demand here. You're seeing shares lower by about 4.5%, as you were mentioning here. And one of the huge things that they also called out was the pivotal year in their ongoing transformation from an internet-centric to an AI-first business. That's how they're looking at this transformation, according to the CEO, Robin Li, and then also saying that AI cloud gained momentum fueled by broad market recognition of some of the full-stack AI capabilities that as part of the statement in their release this morning.
Yeah, there's a lot of focus in this release and on the street taking a look at the quick reaction on AI and the opportunity that lies ahead. But when you take a look at the stock reaction this morning, you take a look at the fact that shares are under pressure. A lot of that is because of the fact that they did see revenue slide just a bit. Now, it was smaller than expected revenue drop, but still, revenue did shrink just about 2% to 34.1 billion won in the most recent quarter. So again, a bit concerning here from the street when you take into account some of the more macro pressures that the company is up against. So yes, they are dealing with a weakening consumer within the Chinese market. They are dealing with some headwinds here just in terms of rising geopolitical tensions between the U.S. and China. That, of course, is among the headwinds that faces Baidu here in the immediate term. But again, when you take a look at maybe the longer term horizon, there still is a lot of optimism. You're seeing that in the commentary out on the street this morning. A lot of that obviously surrounding the AI business and the growth potential of that division.
Yeah, the AI division needs to grow quickly for this company in order to offset some of the declines that they did see in the streaming platform. That was a decline of about 14% in revenue, and then additionally on the online marketing revenue, that declined by about 7% during the quarter.
All right, we'll keep it right here on Yahoo Finance. Much more coming up ahead. We've got the opening bell when we come back.
Welcome back, everyone. You're taking a live look at the opening bell at the New York Stock Exchange. Prudential celebrating 150 years. Wow, where were you when? And yeah, if you were around, then my goodness, good for you. And Triller also celebrating the opening bell at the Nasdaq. There you're taking a look at some funfetti popping off in the air in Times Square. All right, let's take a look at where we open here on the first trading day of the week here, holiday abbreviated trading week. You're seeing the Dow right now open up flat, but to the downside by about, we'll call it 0.04%. The Nasdaq Composite, that's calibrating here this morning. We did see some gains coming into the start of today's trading activity. The S&P 500, you're seeing that start off the day fractionally higher by about 0.1%, and the Nasdaq looks like it's calibrating higher by about 0.2%. We'll round that off too. Let's take a look at some of the sector activity. 11 sectors in the S&P 500. We've got them loaded up here for you on the screen. It seems like we've got more gainers than decliners here, almost about as split as you can get. It's 11 sectors, so we can't split one of them down the middle unless one of them is flat. And financials trying its best to do that. But anyway, that's flat just barely to the upside here. Ultimately, you got staples pulling up the caboose. You got technology leading right now. Let's take a look at a little bit more of that technology landscape with the Nasdaq 100. My goodness, if we could fit the entire Nasdaq Composite up here, you would have to do a lot of squinty activity to really get a full picture of some of your favorite stocks. But anyway, speaking of some of your favorite stocks, Nvidia, that starts off the day higher by about 2.25% right now. You're also taking a look at Microsoft, Apple, Amazon. We've got some flattish to the upside moves there, and then Meta. My goodness, what a run Meta had, but we'll see ultimately. Let me just populate this chart for year to date. Why not? Just so you can get a, all right, it's not going to populate for me. There you go. Jared Blickery helped me out there. I could see him clicking the touchpad out there. So anyway, there you're taking a look at Meta Platforms up 25% year to date. Speaking of the aforementioned man himself, Jared Blickery, let's get on over to him for a deeper look at what's looking. Thanks so much for the assist, Jared.
Thank you. I'll take the credit, even though I didn't touch anything. The Wi-Fi Interactive has a mind of its own some mornings, and let's hope it's benevolent today. S&P 500 and the Nasdaq coming off record weekly closes, not on the daily basis, but for the week. And you can see here we have this nice cup and handle pattern that it looks like it's trying to break to the upside. I did some seasonality work last week, and I would want to highlight that the back half of February, which we are in right now, can have a little bit of bearish seasonality. So that might be a headwind. But the important thing to remember is we are right by record highs here, and that would be the fourth day to the upside for the Nasdaq. Want to take a look at the 10-year T-note yield as well. That is up just a few basis points, and we'll see if we can get that to populate. There we go, up 5 basis points. And the US dollar also jumping after 3 down days. You can see it's in the short-term downward channel there, not making any headway to the upside or the downside. So we move on. And let's take a look at the sector action one more time. Tech is still leading. We have a bunch of defensive sectors lagging. That would be staples, healthcare, communication services not. There we go. Real estate is another one, so we'll take that. And if we go over to the Nasdaq one more time, I want to show you Meta. Now, Meta is in the red right now, but what it has been doing the last week or so, 2 weeks, is it has been gapping down, and I'm going to talk about the gap in about 30 minutes here, but it's been gapping down, then it is closed in the green, with the result that year to date it is up almost 30% right now. We'll see if this populates, but 30% and 21 days would be the new total if we can get that there. Nvidia too, Nvidia surging another 3%. It is now within 5% of its record high, so that's something we want to track as well. We have its earnings approaching. And then I got to show you what's going on in China. China has just been this juggernaut day after day. It has been showing a lot of strength. Not all these names. You can see there's a lot of red on the screen there. But the ETFs like FXI, KWEB, those are all up to 4-month highs right now. And you can see this illustrated with Bob. I'll just show you the 4-day. Maybe we can get that. 13% in 4 days. That is impressive for a large stock like that. I'm going to close with Bitcoin. Bitcoin has been doing a whole lot of nothing for about the last 10 trading days. This is the last 4, but I'll show you the year to date, and you can see how the range has just really contracted here. That just means it's coiling for a breakout. Will it be to the upside or the downside? We will have to wait and see. Back to you guys.
We will wait and see. All right, Jared, thanks so much. Jared just mentioned the strong dollar, the dollar moving higher this morning ahead of another week of earnings from companies including Alibaba, Walmart, and Rivian. One trend emerging so far this earnings season has been that strong dollar, with big tech behemoths to consumer-facing brands mentioning FX headwinds in both their results and forward-looking guidance. Here to break it all down is our very own Alexandra Canal. Ali, what have we been hearing?
Hey, Shauna. So we've seen some pretty volatile dollar moves over the past month or so, really since Trump's inauguration, and the dollar has moved primarily on trade and tariff news. It's very sensitive to those headlines. And since the election, we've seen this sharp rise in what's called the U.S. dollar index, again, tied to those expected protectionist policies from the Trump administration. So if we take a look at this index, which measures the U.S. dollar with a basket of 6 foreign currencies, you'll see that around the election in November, we saw an uptick here. Again, we've been steadily climbing into this January high. This was a 2-year high. We've been bouncing around a little bit there, but still over a 6-month period, we're up about 5%. If we take a look at a 3-month chart, we're still up about 1%. But that rising dollar, it has pressured earnings, especially for companies that do most of their business overseas, since that will lead to slower revenue and earnings growth over time due to unfavorable foreign exchange conversions. And to that point, mega cap tech, we think it's invincible all the time, but they actually generate a significant amount of revenue internationally. Apple reported roughly 58% of overall revenue from international sales in its most recent quarter, and the percentage of overseas sales from other Mag 7 players like Alphabet, Microsoft, Tesla, Meta, that came in at roughly 50% or higher for all of 2024. And even Amazon, which only generates about 23% of revenue internationally, that's according to their latest report, they reported an approximate $900 million hit from foreign exchange. And because of that, it's possible the company could experience its slowest revenue quarter in its history for Q1. But it's not just tech companies. Coca-Cola, Johnson & Johnson, McDonald's, all of these businesses, consumer-facing brands, they're feeling that impact. And Goldman Sachs actually predicts that the dollar could appreciate by another 3% over the next 12 months. So perhaps a little bit more pain ahead. Shauna?
All right, Ali, thanks so much. Let's stick with the dollar. The greenback strengthening against its peers today as Fed Governor Chris Waller says that recent data supports the central bank's decision to keep rates on hold. But could President Trump's protectionist policies damage growth and also slow the buck's run? Joining us now, we want to bring in Jane Foley, Rabobank's head of FX strategy. Jane, it's great to have you back here on Yahoo Finance. Let's talk about, we are seeing the dollar back in the green here today, strengthening just a bit, but we have certainly seen this move to the downside. I'm curious just in terms of what that signals for you and whether or not this is the start of a larger pullback, more broadly speaking, that we've seen in the dollar.
Well, I suppose we have to give it a little bit more perspective. And if we think about the gains in that dollar index through the fourth quarter, well, really right at the end of September up till I think it was about the 13th of January, that dollar index gained about 10%. And since then, it's down about 3%. So if we look at those figures, well, we could say that this is profit taking, but I think it's a little bit more than just that. So what we had last year, we had those animal spirits. We had a lot of anticipation about the type of growth in the US and the inflation that was going to be brought about by Trump's policies. Now, since early January, the market's begun to rethink that. Now, if you recall, of course, when Trump threatened tariffs on Colombia and then backed down when Colombia agreed to back down on an immigration issue. Similarly, when the threat of tariffs was used on Mexico and Canada and then back down when a border issue was agreed, the markets realized that the threat of tariffs isn't going to be just about all trade, about putting a tax on US consumers effectively. The threats of tariffs are often going to be used for foreign policy objectives. So the markets have reconsidered the inflationary impact of Trump's policy, which is part of the reason we've had that move lower in the dollar this year. And so how do you think the Fed will be running its calculus around the impact? Well, although, you could say, well, surely that's sort of good news for the Fed, a little bit less inflation. I don't think that they are going to be relaxing on that because there probably will still be tariffs. In fact, we still have had tariffs on China, of course, tariffs on steel and aluminium, etc. We are expecting more tariffs on the EU, maybe on Japan, potentially as well. So we are going to get an inflationary impact in the US from tariffs. But the other thing is that if we look at US CPI inflation right now, which is the January reading, that's the latest one that we have, we already have sticky price pressures, core inflation, of course, pushing higher in the US. And that reflects a period before Trump's policies have had a chance to really make an impact. So what we're saying is that, well, because we had stronger data on growth really for the US through the autumn, we're starting off this administration for Trump with quite sticky inflation already, and the Fed is going to have to react to that. So we think there may be one more interest rate cut from the Federal Reserve this year, but maybe not. If we hear more tariff news, well, that door could shut fast, and that would give support to the US dollar.
How much support, Jane?
Well, in terms of the euro, say the euro dollar, we still think that there's a good chance that we could see parity. We're not forecasting below that right now because there is also a little bit of stickiness in European services inflation. So we do think that the ECB is nearing their terminal rate, a couple more interest rate cuts from them. The market thinks maybe 3 and then a pause. So we're not forecasting below parity, but we do still think that we could still have dollar strength. But it really does depend on how quickly some of these policies from Trump do come through.
Jane, as we have a big week here where we're going to be getting some Fed meeting minutes, but we're also going to hear a couple of the committee members who are going to be out making some comments, speaking this week, a couple of them doing it twice. So all of those things considered, what could these committee members say that ultimately kind of reframe the thinking around the number and ultimately perhaps even a reduction of the number of rate cuts?
Well, you're absolutely right. The majority of Fed voters will be speaking this week. So it is something that the market will be paying attention to. Now, the Fed has signaled that they could cut interest rates twice more this cycle. The market is thinking maybe 1 to 2, so maybe a little bit less. Here at Rabobank, we're thinking maybe 0 to 1. And I think the combination of those comments plus, the economic data that we'll be getting in the next few weeks will really help fine tune and frame the market's idea about how much realistically in terms of easing the Fed is likely to do this year.
Jane, thanks so much for taking the time. Jane Foley of Rabobank. It's time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at investor sentiment. Hey, Maddie.
Hey, Brad. Yeah, investor sentiment turning bearish and hitting a record level of bearishness. If you take a look at this chart behind me from the American Association of Individual Investors, a survey that we love to look at, investor bearishness hitting 47%. That's a record high going back to 2023. So what's driving some of this bearishness that we're getting in the market? Well, policy uncertainty is certainly among those top drivers of this bearish sentiment, both in terms of policy from the White House and policy that could be coming from the Federal Reserve. Specifically, though, when it comes to the White House, tariffs in particular, a huge area of uncertainty. 57% of investors surveyed in this same group said that tariffs could hurt growth and increase prices. That's potentially why we're also starting to see a little bit of a rotation out of some of those big tech names. And even U.S. equities in particular, we're starting to see outflows into equities over the pond here. We're seeing Europe stocks in particular outperforming U.S. equities year to date. Also, investors pouring into global stocks with cash levels at record low levels, but 89% of these investors also said that U.S. equities are overvalued. So that could be another bull case for those European equities. Of course, we're going to continue to monitor. This survey in particular is a really good kind of way to gauge investor sentiment, but interesting to see that bearishness hitting a record level, particularly as I mentioned, as those mega cap tech stocks continue to be under pressure, guys.
All right, Maddie, thanks so much for breaking that down for us. Coming up, Walmart kicking off retail earnings this week. We are going to take a look at the biggest things that investors should be watching out for. That's coming up next on Morning Brief. Walmart set to report fourth quarter results on Thursday before the market opens, and analysts are expecting a strong report off the back of a very strong holiday season. Joining us now, let's bring in Corey Tarlow. He's Jefferies Senior Vice President of Equity Research. Corey, it's great to have you back here on Yahoo Finance. Let's talk about what we could hear from Walmart later on this week. Certainly expectations are high. Do you think they will live up to those lofty expectations?
Good morning, and thank you for having me. What I would say is that the answer would be yes. I know expectations are high, but we think that Walmart delivers, very simply. And we think they deliver above expectations. And one thing that we're looking at specifically is this is a global retailer, but we're specifically looking at the U.S. business in particular, which is where our data really gives us an edge. And right now, as we look for the current quarter that they're going to print again on Thursday, current consensus numbers are about a 4% same-store sales growth metric for the fourth quarter. And based on our data, which looks at foot traffic and receipt data, we're actually closer to about 5%. And if you recall last quarter, it was a very similar story where you had a 4% consensus number and a beat by Walmart, but close to 5%, and the stock was up. So we think that 3Q, very similar story plays out here again in 4Q as well.
And so does that mean even more of the strength that you're anticipating among some of the more affluent consumers coming into a Walmart, trading in, as they would call it, to that experience, whether it be at Walmart or at Sam's Club?
Yeah, I mean, 3/4 of Walmart's market share gains have actually come from higher income customers. And this is a $450 billion retailer in the U.S. that's comping up 5%. So it's seeing incremental dollars flow into the tunes of billions. And it has to come from somewhere. And a lot of these higher income consumers have helped to really fuel that growth. And Walmart's always led on value. But one thing that they've, I think, really improved on in the last several years is convenience. With buy online, pick up in store, buy online, ship to home. They now have express delivery. They have even drone delivery in certain markets. And I think this convenience aspect has really helped to acquire and retain a lot of these higher income customers, many of whom are taking advantage of the benefits now through Walmart Plus, which is a relatively new program that the company has. So the combination of all these different things, I think, have really helped to propel their growth and probably even make this growth more sustainable into the future, which is why Walmart's one of our top picks for 2025.
Corey, what about tariffs, though? How big of a risk?
Well, 2/3 of Walmart's business is food, and a lot of that is produced domestically. So we'd actually see more risk in tariffs in other stocks that source more internationally, where exposure to China is a little bit higher. So again, because it's mostly a food business, we see the risk as relatively lower. It's still a risk to numbers, but ultimately that probably just gets passed through in the form of higher prices.
Corey, are they able to do that, though, at this juncture, just given the macro environment right now and given the trading down or trading in, whatever you want to call it, that we have seen from consumers?
I think it will be passed through in terms of higher prices, as I mentioned. But this comes with the caveat that, yes, they might pass through higher prices as a result of tariffs, but their prices are still lower than just about everywhere else. In fact, we do a weekly survey of Walmart's pricing relative to other retailers, and the value gaps continue to be very, very wide. And just as one example, we take a look at private label price gaps. So a brand like Great Value, which is Walmart's private label brand, versus a name brand. And historically, those price gaps used to be about 25%. And now they're getting close to about 50% in certain categories. So I think this just illustrates to you that, yes, while tariffs could result in higher prices, you're still going to see a much more significant value gap in Walmart's offering relative to other retailers, which is going to make Walmart's proposition that much more attractive going forward, in our view.
Corey, is Walmart still the name for the best returns for shareholder value in the retail landscape right now? Over the past 2 years, we're taking a look at this chart. It's up 112%. Hard to believe that it's possible to add on to, or not add on to, but at least duplicate that effort once again.
It's a great question. It's one I think a lot of investors have tried to wrap their heads around. I was just marketing across 4 different cities and met with over 50 investors over the last week. And I think this is something that a lot of people are trying to better understand and to get comfortable with, which is the growth that we've seen in Walmart and what that portends for the growth going forward. And our belief is that if you aggregate all the potential benefits that Walmart's likely to see from the scaling of higher margin revenue streams like advertising and fulfillment services and the addition of automation and AI into their business, all of that should really continue to benefit the P&L. And the last thing here is that we're recommending to buy Walmart, but the stock's at nearly trough margins. So you have a stock that's coming off trough margins. So valuation might appear elevated, but again, margins are close to trough levels. So we think numbers go higher here, and that's going to help to propel the stock even further.
Corey, thanks so much for taking the time here. We're going to be looking forward to this report. We know you will be too.
Thank you.
Coming up, Elon Musk's AI startup unveils a new model rivaling ChatGPT and DeepSeek. What the new chatbot means for the intensifying AI race. That's next on Morning Brief. Elon Musk's startup xAI is debuting an updated AI chatbot tech. It's called Grok 3. According to Musk, the model has more than 10 times the compute power of its predecessor. And xAI claims it beats out OpenAI's ChatGPT, Alphabet's Gemini, and DeepSeek's V3 model on benchmarks measuring math, science, and coding problems here. So, now we've got brouhaha that's forming in the chatbots for some of the major tech companies and billionaire investors who are putting forth all of them their own AI, generative AI chatbots right now.
Yeah, and we know that Musk and Sam Altman from OpenAI have gone head to head. Most recently have certainly been making headlines just about some of their disagreements. Of course, Musk just in the last several days, of course, offering potentially to buy OpenAI's nonprofit arm for just over $97 billion. Of course, OpenAI rejecting that, saying it wasn't an offer at all. So this, of course, just fuels and feeds into that back and forth between Musk and what we have heard from Altman. I wanted to show up. I want to throw up a chart comparing the effectiveness or maybe how much we should trust Grok. Now, this has not been independently verified here, but just in terms of how advanced this chatbot is compared to others that are on the market, and at least according to Musk, it is much more advanced, or at least is more capable than what else is out there. Here we go. We got it up on the screen right now, just in terms of math and science and also in coding. You're seeing that green right there. The bright green is Grok 3 compared to some of its earlier versions. And then you also compare it to Google's Gemini, DeepSeek, and ChatGPT 4.0. So again, has not been independently verified, which is the most important thing to point out in this. But again, Musk and XAI very much saying that this should be and is the most advanced models out there. How much you can trust that, though, is a lot of questions. And that's what the street's debating this morning.
Yeah, you're taking a look at my squinty eyes going into some of the numbers here. And ultimately, I think what it comes back to is the people who have already started using some of these chatbots in one form or another, because that early mover, that first mover advantage plays a big role.
Yeah, it's hard to get people then away from that. All right, keep it right here. Coming up next is Catalyst. We'll be right back. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, we break down the market action and why investors' cash holdings are at record lows.
Plus, global stocks getting a boost as the U.S. and Russia engage in talks. We will break down what the discussions could mean for global markets.
And the race for AI dominance heating up as Elon Musk's XAI unveils its latest artificial intelligence model. All that and more coming up right here on Catalysts. New data offering a mixed picture of sentiment on Wall Street. According to the American Association of Individual Investors, bearishness is at its highest level since November of 2023. On the flip side, according to the latest fund manager survey from Bank of America, Wall Street is feeling bullish. The survey showing cash levels among global fund managers to have dropped to the lowest level since 2010 as investors are long U.S. stocks. Joining us now with more, Tom Becker, BlackRock lead portfolio manager, Tactical Opportunities Fund. Great to have you here, Tom. So investors are long stocks, but they're tipping bullish in some other surveys. Where do we net out on how investors are feeling about the market near term?
Yeah, Maddie, good morning. I think the kind of looking ahead from last year, investors are really looking for kind of the fiscal policy, the changes in the new administration to bring U.S. growth up to another level. We see a continuation of the same, so kind of high nominal growth, inflation kind of a little bit outside of the Fed's comfort zone. And to us, the positioning and the narrative that we had at the end of the last year had us shift some of our equity positioning into foreign markets and also position for U.S. interest rates and financial conditions to tighten a little bit.
Where within the foreign markets are you seeing that opportunity, Tom?
Europe was actually a place that was pretty hit negatively by the tariff sentiment. Mm-hmm. So expectations around tariffs really centered around European equities. Europe's had a tough growth run over the last couple of years, but a lot of those companies are pretty foreign exposed. They sell into international markets, and they also have a lot of goods exposure. We're seeing year to date kind of broad-based commodities lift. China may be bottoming, some positive sentiment over the weekend in China. Also some sentiment in Europe now around kind of the rearmament and kind of figuring out how to deal with Ukraine, maybe fiscal loosening a little bit. All of that, given positioning, made Europe a little bit of an attractive entry point.
Would you say that you are more bullish equities outside of the U.S. overall then? Because it's interesting given the run-up that we have seen in U.S. equities. It's been hard to afford to stay out of them the past couple of years.
Yeah, very much so. And so I think we put a lot of weight on what's priced and investor positioning. And I think kind of some of the positioning indicators that we look at toward the end of last year looked a little bit overstretched in the U.S. And so risk return looked like some of these unloved foreign markets offered a little bit better opportunity. If you think about kind of, last year you had the Fed deliver 100 basis points of cuts, they tapered QT. Coming into this year, it looks a little bit harder for them to be able to deliver another round of easing. Inflation's proving much stickier at 3%. We think quantitative tightening could last longer, given some of the deregulation and some of the loosening of financial markets could allow kind of the balance sheet to shrink more and further than is expected. All of that, we think, could have U.S. financial conditions be a little bit looser compared to foreign markets. That should support foreign equities.
Tom, I'm just curious, just given so much uncertainty surrounding Trump policies and what exactly the impact is going to be, how they are going to evolve here over not only the coming months, but really over the next 4 years. At this juncture, I guess, how big of a headwind do you see it potentially being to U.S. corporate earnings, at least over the next couple of quarters?
Yeah, I think the uncertainty, you kind of point to the right facet of it right here. So it is very uncertain what's going to happen in terms of tariffs, how big, against whom, also kind of the negotiations around one bill versus two bills, TCJA extension, as well as potentially some of the tax cuts that were discussed on the campaign trail. Overall, we think the lean is going to be for more fiscal stimulus. So an extension of the current tax cuts plus additional tax cuts on the margin. That is going to be kind of a little bit of fuel to an economy that's already settling at a high inflation rate, and also is going to necessitate quite a bit more bond issuance when we come into the second half of the year. we think bond investors are going to kind of take heed potentially once we get some of the legislation between the House and the Senate a little clearer about the fiscal ramifications. And I think right here from this juncture in the U.S. economy, additional fiscal stimulus could pose problems for the long end of the yield curve.
It sounds like then the problem is not necessarily the policy itself being implemented, it's more the uncertainty. Given that, would you rather have tariff news that is objectively negative for markets but is clear today versus this back and forth negotiation?
I mean, in terms of how we're positioned, we think U.S. inflation is going to stay sticky and high. So some certainty on the tariffs and kind of the amount of kind of price impact of those would be helpful. That said, I think, our expectation is that there's going to be some constellation of tariffs that is going to keep goods inflation high. Services inflation is already pretty high. And so you add those two together and you get above target inflation. I think the market, in terms of it moving on to a new narrative, as we shift away from the tariffs, I do think it is going to come to some of the things that have to get legislated. And there it's going to be pretty interesting to see kind of which trade-offs and which policies get chosen.
All right, Tom Becker of BlackRock, thanks so much for taking the time to join us here this morning. I appreciate it.
Sure. Thanks very much.
Keep it right here on Yahoo Finance. We've got much more of your market action ahead. Stay tuned. We'll be right back. most important time of day for the U.S. stock market may not be between the bells, rather outside trading hours. Big overnight moves could have big consequences for the next day's trade. Let's talk about that and more when we think about your portfolio and hear with what this gap means for your money as Yahoo Finance Markets and data editor and also host of Stocks in Translation, Jared Blickery. So Jared,
yes.
Translate all of this for me.
All right, gap. It's only 3 letters. We're going to break it down. It's pretty easy to understand once you see a picture worth 1,000 words. We'll get to that in a second. First, the definition. The gap is when a stock or other trading instrument, could be any security, could be a cryptocurrency, opens higher or lower than its prior close. And even if it doesn't close and there's continuous trading, you can still have gaps. Now, this has important ramifications for not only active traders and day traders, but also passive investors. And we'll get to some of those last. But first, we want to say that gaps tend to get filled. Not always. There's a saying that all gaps get filled. No, there are some Dow gaps from the 19-teens that have not been filled. I hope they never are. And then gap fills often lead to market reversals. And that's on an intraday basis. So let me give you an example of what happened last week in the S&P 500. I'm going to pull up a 5-day chart with daily bars here. You can see four bars here. Yesterday was a holiday. And we haven't had much going on these last 2 days. I want to focus on what happened last Wednesday to Thursday. So last Wednesday, we closed right here. And then we opened up the next morning right here, slightly above that. And it's hard to see, but there's a little wick right here that says that the market went down there, touched this level almost precisely, and then it took off and closed much higher, right around 61.20. So going back to our example here, this has important ramifications also for passive investors because as it turns out, one of the best times to be in the market is actually while everybody is sleeping. And let me just illustrate that by, we've broken down the market, this entire bull market going back to October of 22, and the different times of day have different results here. So 9:30 a.m. to 11:30 a.m. has resulted in some profits here, but not a lot. You can see it's basically been going sideways for the last 2 years. And then if we take a look at the 11:30 a.m. to 2 p.m., that has trended up and had some nice gains there. And then we take a look at the 2 p.m. to 4 p.m. That is barely positive. In fact, there was a nasty Fed day last month or 2 months ago in December that really brought this back down to zero. But I would highlight that 2 p.m. to 4 p.m. is supposed to be the smart money hour or 2 hours there. Just not the case this bull market. What has been a stalwart is the overnight market. And this has really taken off since about the second quarter of 2021. And you can see this highlighted here. If I break down overnight versus regular trading hours, and the green here is regular trading hours, and the gap is overnight. And you can see this has just really trended up strongly since the beginning or first or second quarter of 2024. After a kind of false start here, we had a lower low in the beginning of this bull market. But as you can see with the green line really hasn't done much over the last year. In fact, you could easily say that it's been trending down. So if you were only in the market during the day, you were missing out on a lot of the gains that are happening in this market overnight. So while not all gaps fill, we do need to pay attention to it because it does have those ramifications for both short-term traders and the longer-term passive investors. Back to you.
All right, Jared, a really great breakdown. Thank you so much. Appreciate it. The latest Bank of America fund manager survey showing investor cash holdings at a 15-year low. Compare that to Warren Buffett, who's sitting on a record cash pile at over $325 billion. While he's put some of that dry powder to use in the fourth quarter, he's also trimmed and exited several positions. Joining us now on this, we've got Lee Munson, President and Chief Investment Officer at Portfolio Wealth Advisors. Lee, great to speak with you. Buffett's cash holdings in particular seem to get a lot of attention because folks are concerned that it is a bearish signal for the market if Buffett is not invested in U.S. stocks. What can you tell us about that?
Well, a lot of this stems from a huge sale of Apple that he did last year, and he just has a bunch of cash and he's slow to get it to use. They have been on a buying spree with Occidental, and I think that that's something that is notable. They bought a ton in December. They bought a ton this year. And so I think it's about what qualities that Buffett likes, and he's looking for things that have strong cash flow, assets that aren't going to go anywhere. And I think he's got a real, he's got a real love for Occidental because they have these quality properties, or let's just say these assets in the Permian Basin, and they're paying down debt. So I think that what it really says is that this is a momentum market. It's hard to find good value right now, and I think that Buffett is waiting his time. But I don't think we should, have this. I don't think we should think just because he has a lot of cash, it means the market is ready to fall per se. I mean, look at Occidental. In the past, since I think last April, it's down 30%. And so there are things in the market that are down, beaten up, left for dead that you can buy here.
Lee, what do you think this tells us about Buffett's and his team's just longer term strategy, just in terms of the opportunity that they have identified within Occidental? They like buying beaten down stocks. They like seeing some of the companies that they could potentially turn around. So what does this signal maybe about that strategy and what that looks like for what's ahead?
Well, I think there's some sense that, there's always going to be Buffett haters. There's always going to be people who think that what that team does is too slow moving, that there's not a lot of, there's not enough opportunity set. I disagree. I think it's just a style. We're in a market for years now that has been based on big tech companies promising ever larger growth and in revenues. But I think that when you look at the type of trades that he's doing and the type of positions that they're putting on, it really goes, I don't think anything's changed in 10, 15, 20 years or even beyond that of what their strategy is. I think that you can look at what they're buying and it's just a completely different philosophy of the market than is Facebook going to hit their earnings and are they going to have an AI agent by the end of the year.
To focus specifically on Occidental, though, it's interesting because, and you mentioned this in your note, it's not a company that is hedged on oil prices and, of course, is at risk of the potential depression in oil prices, which is something that we have been seeing. How risky does that make this name, particularly given both the geopolitical backdrop abroad and then also here at home?
Risk, I think Buffett said risk is not knowing what you're doing, and I think that the Occidental is a good example of this. I was long this stock several years back when it was in the high 50s, early 60s. It went sideways for a while. I wasn't making money, and I had to go and get busy. Now you come back, you look around, you think, hey, this thing's down 30% from where I last traded it. We're going to see some earnings today. We're going to see how bad the cash flow is. I think that you have to take a longer-term view. Do you think that assets in the Permian Basin are going to be more or less valuable 3-5 years from now? Do you think that upstream, the exploration with Trump's America right now, do you think that's going to be a headwind for Occidental? I think so. Occidental, the narrative is confusing. They've got midstream, they've got the chemical company, they got the carbon capture, and I think Wall Street doesn't like not having a pure play. But I think that if you like assets, if you want to do an asset play, and you believe that Buffett really believes so much in Occidental and their management team, I think it's worth looking at. But I would rather wait for some bad earnings. I'd rather wait for Wall Street to completely leave this thing for dead. It could get worse because their cash flow is going down right at a time that they need to be paying down debt. So I'd actually like to take a page from Buffett's thing and rejoice when stock prices are down. I just think Occidental has a lot of risk this year. We've got a president who's trying to lower energy prices, but on the other side, he's going to loosen up regulation. And the strategy that Occidental is doing right now, it's great. Just remember, you're not going to get a clean narrative. It's never going to be a hot momentum stock. And if it's going to work, it's going to be a sleeper hit.
Lee, what about some of the other moves that we've seen Berkshire make? Constellation Brands, that's a new holding here, adding to Domino's, adding to Pool Corp, adding to SiriusXM. What does that tell you?
Well, I think he's just knee-deep in the value trade. He just does not care about some of the broader things that are happening in AI or what have you. They're looking at staples. They're looking at things that people use every day. I'm fascinated by the satellite radio. I'm on satellite radio every day. It's not something that's going to go away. I've got, a ton of cars. I'm always upset, someday I'm going to call them and say, stop charging for my teenage daughter's car for $10 a month. But you know what? He knows about inertia. He knows about the U.S. consumer. And so I think that you can look at that, and I think he thinks that the U.S. consumer is just fine. They're going to keep paying for staples, and a moat is a moat. I just think a lot of what he's doing is unpopular right now. And until we see some big disappointments in the Mag 7, you're not going to see a lot of lift on these stocks.
All right, Lee, always great to talk to you. Thanks so much for taking the time to join us here this morning.
Thank you.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of this session. That's what the Yahoo Finance's trending tickers page. First up, merger talks between Honda and Nissan could potentially be back on, with one caveat though. Nissan's current CEO must step down. That's according to the latest report from the Financial Times. Now the FT is saying that the $60 billion merger will become the fourth largest automaker in the world. Of course, this has been a back and forth. Previous talks had pretty much collapsed because of some of that internal resistance inside Nissan. So of course, this is contingent upon the fact that only if Nissan CEO agrees to step down here, Maddie. But I think this more so highlights just the tough position that Nissan is in right now, just in terms of the fact that they're dealing with tougher competition, especially what's happening with domestic players inside China. They talk about the fact that obviously that has weighed on earnings most recently. They've been forced to lay out some cost-cutting measures. So the future of Nissan, as they still come, obviously very much in question, I would say challenged, at least at this point, in terms of the view from the street.
And it's interesting, too, given that we are seeing the move in Nissan to the upside and Honda to the downside. You never want to see that when you are the CEO and your stock moves to the upside on rumors of your potential ousting. Makoto Yoshida is the CEO of Nissan. He has signaled an interest in staying in the role at least until 2026. So given this scrutiny from the board, it may not be enough to obviously make him have a forced exit. But this merger with Honda, really critical for Nissan, which has been struggling with sales in Japan and more broadly across the globe due to some of that competition from electric vehicles in Asia that we have been seeing continuing to pressure Nissan. So they are certainly looking for a potential deal. Having said that, we also know that Foxconn has been considering that stake in Nissan following this deal falling through with Honda. So that's another potential partner for them moving forward if this deal does not go through or revive in talks, which has been on again, off again relationship over the past couple of years.
Yeah, something tells me this is not the last that we're going to be hearing about this.
Exactly, absolutely. All right, well, Alibaba shares also moving higher. Investors looking ahead to earnings out Thursday before the market open. The Chinese tech giant coming off a strong week amid AI optimism and its partnership with Apple. Alibaba co-founder Jack Ma was among those Chinese tech leaders who met with Chinese President Xi Jinping on Monday as the country is looking to become more business friendly. It's hard to overstate how critical that meeting was too, because Xi Jinping has not been meeting with business leaders for several years now. Jack Ma has not been seen in any of those meetings for several years. So really critical to see kind of that friendlier approach. And I think it's interesting given that it sort of mirrors what we've seen here at home with the White House favoring big tech CEOs, having that friendlier relationship, and now we're starting to see that abroad as well. That led to a lift in Chinese tech names overnight. It'll be interesting to see if that can sustain into those Alibaba earnings.
Yeah, that certainly is a great point. And you take a look at Alibaba, just the stock performance over the last year very much speaks to the outlook and the impact of the potential there surrounding AI growth and some of the investments that have been made. When you take a look at that 1 year chart, you are looking at gains of just over 70%. So again, going into the results later on this week, expectations are high. But again, when you talk about the focus, even within China, of some of their more domestic players, you talk about the fact that they are very competitive, remain very competitive to other worldwide leaders. You certainly have seen some of the concern here within the U.S. when we got the developments out of DeepSeek and potentially what that means. And then, of course, the news from Alibaba following just a few days later. So again, when you take into account just where China stands right now, the competitiveness that they are offering on the AI landscape and where they are within that race and the competition that they are providing here to the U.S., certainly a lot will be riding on that specific portion of the results that we are going to be getting at. We'll see whether or not it does live up to those lofty expectations.
Yeah, and the interest in investing in tech abroad is something that we're going to continue to monitor. We're talking with Mitchell Green later in the show, venture capitalist, and he'll be giving us his insights on the AI trade as well. We'll have all your markets action ahead, so stick around for those conversations and more. You're watching Catalysts.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Elon Musk's artificial intelligence startup debuted its latest chatbot to challenge OpenAI days after the billionaire's bid to buy the company was rejected. Now, XAI claiming that its Grok 3 chatbot beats DeepSeek, OpenAI, Alphabet, and Anthropic's models across several benchmarks. Joining us now to discuss the race in AI, we want to bring in Mitchell Green. He's the founder of VC firm Lead Edge Capital. Mitchell, it's great to have you back here on Yahoo Finance. Let's first talk about some of these developments that we've gotten here over the last several hours from Elon Musk, some of the capabilities, what he's claiming just in terms of how advanced Grok 3 is. What do you think that means just in terms of the implications and immediate implications here for the broader AI industry?
Well, Madison, thanks so much for having me on. What do I think? I think you're going to see over the next 6, 12, 18, 24 months, lots of people continue to, show that their models are faster and faster. As you saw in DeepSeek, you'll see that things get, cheaper and cheaper. I think it's going to be a long race. And at the end of the day, I think the largest companies in the world will probably end up winning this race. It's just incredible how much money companies like Microsoft and Google and Facebook and Amazon are going to spend on this stuff over the next few years. I think it's, something like $250 to $300 billion or something in the next 12 months from some of these large internet companies. I don't know how some of these private companies can keep up, but we shall see.
So it sounds like you see that CapEx as a negative, Mitchell. I want to get your take then on some of these kind of old school names, the likes of Oracle, IBM, Cisco, really outperforming some of those other Magnificent Seven names that you just mentioned. Do you see that dynamic continuing? And do you see those kind of old school names becoming AI winners?
That's a great question. Companies, Oracle is already, I think Larry has come out and said that he wants to aggressively invest in AI. I'm sure IBM will as well. IBM's for years has said things around machine learning. The companies that are, the companies that are supplying equipment, technology, all of these, these hyperscalers that are trying to spend these giant CapEx dollars are going to win, are going to at least win in the near term by providing giant amounts of capital into the sector, equipment into the sector. I worry a little bit that this is the telecom boom and bust, although it did eventually boom again. I just worry that we will provide so much, there's going to be so much infrastructure needed, and we'll overbuild for it in the near term. But over the long term, I guess another way to put it is people tend to overestimate technological change in near term, but they always tend to underestimate it in the long term. And then, of course, spending, kind of goes the same way.
Mitchell, I guess what metrics then are you using to evaluate just where this race stands with AI and some of the larger companies, obviously much larger companies, versus some of these startups?
Yeah, so in the startup world, we have what's called our lead edge 8 criteria, and it's how we evaluate every business. One of the key criteria that we like to evaluate is what we call gross dollar retention. That is, if you end the year December 31st with $10 million of revenue, at the end of the year, 12 months later, at the end of the next year, what are your revenues from those exact same customers before you have any upsells? So a lot of entrepreneurs like to quote they have 130, 140, 150% net dollar retention, which includes the upsells, which would be downsells plus upsells. However, best-in-class software companies tend to start with $10 million on Gen 1 and end the year with, $9 million. So they'd have 10% churn, 90% gross dollar retention. World-class companies have 95%. Oftentimes, we're looking at many of these pure AI startups or earlier stage companies, and we're seeing them have gross dollar retention of $5 million or 50%. The problem is they're just churning through customers so fast. And what you're seeing is a lot of companies trying things. Some things kind of work out. Some things kind of don't work out that well. And so for us, the pure AI software companies, as a result of low gross dollar retentions, has been our biggest impediment to invest in the sector. That being said, every portfolio company in our portfolio is playing around with AI, just as I'm sure you guys are at Yahoo or CNBC and Bloomberg, and everybody is. Everybody's trying things. Some things work slightly better than others. It's still the very early innings, but we have every company in our portfolio has tasked different people in the organization to figure out how to use AI in different ways.
So is AI for efficiency's sake enough, for cost cutting enough, or do you want to see these companies charging for AI? Do you want to see ChatGPT paywalled?
I think you're going to see it because the costs of providing the service are much more expensive than your typical search. You're going to see Microsoft come out with products. There's already multiple tiers that you can pay for, OpenAI. I think there's the $20 a month and there's the $200 a month one for deep research on it. Look, we have companies in our portfolio that are not only working on cost-cutting initiatives, but trying to also drive revenues through the use of AI technologies embedded in their own products. Where we see a lot of companies winning is the incumbents. And I think it should be stressed that when the iPhone came out, what was it, 2007, 2008-ish timeframe, there's only been a couple companies created since that came out that are worth over $100 billion. You have ByteDance, you have Pinduoduo, they're roughly around there, and Uber and Airbnb. You know who won with the iPad, the iPhone? It is Apple, Amazon, Google, Facebook. I think you're going to see the same thing here. You're going to see companies such as Genesis in the call center space. You're going to see companies like Grafana Labs, which is a really fast-growing developers tools company. You'll see companies like Salesforce and Workday. They're all going to embed AI inside their systems and leverage their existing customers to continue to grow faster and faster.
So then, Mitchell, I guess the investor question here is, what does that next wave of AI investment, who are there winners beyond who's already leading?
I suspect so AI will change the world. It's going to change it over the next 10, 15, 20 plus years. If you looked at the internet boom in 99 or 2000, I don't think we would have sat on this show and said the winner, the definitive winner today is going to be Amazon, and the other giant winner will be this company you've never heard of called Facebook, and this company you've never heard of called ByteDance. And, but by the way, Walmart is also going to build a giant e-commerce business. And so I suspect companies that will be the biggest companies in AI over the next 20 years will be companies that we haven't even thought of, that like are in their infancy now or not even created. But yet companies such as Salesforce, Microsoft, Workday will build giant businesses. OpenAI, they've built a huge consumer brand. It's obviously really powerful, and it's taken the hearts and minds of consumers right now. But I just don't know how that company can compete over the long term with the amount of money that these large hyperscalers are spending on CapEx. Not that it's an incredible product. I use the product, but I struggle with, can the foundational models come out of a company other than one of the big hyperscalers, just given the CapEx requirements. But time will tell.
Mitchell, I want to end on ByteDance. Obviously, you are an investor. TikTok's fate in the United States still up in the air a little bit. It's back on the app stores, though. How do you suss out the viability of your investment in ByteDance, given just the lack of transparency into the company? What is it that you're seeing that other investors might not be seeing?
That's a great question. Well, to be clear, there are other big investors: General Atlantic, Sequoia. You have people like, I think Hillhouse is an investor in it. Cotu. You have a bunch of Tiger Global. A bunch of very strong other investors. For us, our base case has always been, since we made the investment over the last few years, is that the U.S. business, we valued it in our model at zero. The U.S. just isn't that much of the overall business right now. We get financials on the company. We're happy with the financials. We have access to senior executives at the company we can talk to. Well, we are not on the board of the company, nor we were not on the board of the company of Alibaba as well, or we were not on the board of Uber or Spotify, but we were provided financials and management access, and which is fairly common in, if you have a large investment in some of these, large, giant private companies. For us, I would say that for several years, we've said the value of the U.S. business was zero. It sure appears, looking in, that the U.S. government and Trump want to do something to keep the app in the U.S. for U.S. consumers. I think that probably benefits us as American investors in the company, whether it's a spin, it'll be some type of spin out. Your guess is frankly as good as mine on what that would look like at the end of the day. But I think as a U.S. investor, we will probably actually accrue some value to it that we had really created no value in our model with.
Yeah. All right, Mitchell Green, thanks so much. Appreciate it.
Thanks for having me.
We're going to have all your markets action ahead, so stick around for more on Yahoo Finance. You're watching Catalysts.
U.S. and Russian officials at meeting in Saudi Arabia today for extensive negotiation talks as President Trump pushes to end the war in Ukraine. Notably, no Ukrainian officials were part of those discussions. The State Department saying that the meeting is a second step to see if Russia is serious and on the same page. What would an end to the war mean for investor sentiment and the energy trade? Should we see a lifting of sanctions on Russia? Joining us now, we want to bring in Andrei Kozyrov. He's a former foreign minister of Russia, and also Patrick Dahan. He's the head of petroleum analysis at Gas Buddy. It's great to have both of you. Thanks so much for taking the time. Andrei, let me just start with you, just in terms of what is your assessment of the talks that are taking place as we speak right now today? The fact that Ukraine is not involved, the fact that Europe is not involved, what does that tell you?
Well, unfortunately, I think neither Ukraine nor European Union miss anything. You know, looks like very, very empty. They call it preliminary or exploratory, but that's just diplomatic, speak. The talks with Russia, with Putin's Russia, without force, demonstrated force and even used force lead nowhere. The talks in Riyadh ended, as far as I understand, by comments by both sides. There are more comments actually in Russian press, but official also, that there was no movement. Russia stands on its maximalist demands and made no step even aside from that. And they created 4 or something working groups, but working groups on what? On what happens after the peace agreement. And maybe one to look how to reach the agreement or ceasefire, whatever. But that's just, a kind of blame game. The primes, the presidents might blame ministers for not reaching the agreement, and ministers in their turn create working groups to blame them. But from the very beginning, it was absolutely clear to me that Russia will not compromise anything. And they are supposed to compromise their demands for gifts or rewards from the aggression. That is how much more land they will keep, how much more restrictions like demilitarization they will dictate on Ukraine or no NATO. Some of those things already accepted by American side even before the negotiations. But anyway, only force. That's the language that Putin speaks at home, using force against his opposition and everything. And that makes their demands for elections in Ukraine so disgusting, so ironic that there have been no elections, free and fair elections in Russia for 25 years, at least. Yeah. So his concern with the legitimacy of Zelensky is just ridiculous. But that's what they do, they understand force and nothing more.
So, Patrick, I want to bring you into the conversation because it's important to note what Andrei is saying here was echoed by Vladimir Zelensky, who said no deal about us without us. Obviously, Ukraine not involved in those discussions. Given the lack of clarity about the likelihood of this resolution coming to fruition, how big an impact do you anticipate happening in terms of the energy market and crude oil specifically?
Well, look, I think there could be huge implications for the U.S., for Russia, if a deal does materialize. But to your point, it's not going to be as successful if Ukraine doesn't have an active voice at the table. If Europe's interests are forgotten, now the U.S. is assured that as these talks potentially progress, there will be room for Ukraine and potentially interest from Europe. And I think the Trump administration certainly could carve out somewhat of a victory here if everything goes well, if sanctions on Russia are eased. That certainly could put downward pressure on oil. And of course, President Trump has promised to lower energy prices. So there are huge implications. But the biggest question is, will Russia move forward? Will they add demands? And how successful will the talks be?
Andrei, how likely is a meeting between Putin and Trump?
I can add something to the oil as a Russian foreign minister. I try to follow the oil kind of drama or play, and it's absolutely impossible to predict the curve of the oil price even for short time, not to speak for long time. And if Russia is now trading oil with China and India on discounts, but still, and if sanctions removed, they will trade more but that does not necessarily mean a lowering of the oil price, because it's a very, very tricky subject. And also what is important, that even if Saudi Arabia and Russia and all other OPEC or whatever concede to lower the oil price, then the oil industry in the United States might be hurt much more than Russian oil industry, which is established, and especially Saudi oil, which is cheap and high quality. So you should be careful what you ask for.
And Andre, to that point, we are seeing some support in the markets here, at least today, for the crude market when you take into account the strike that we saw potentially at that pumping station in Russia. But going back to what I asked before, just how likely do you think is the meeting that we are going to see within the next several days, within the next week or two, between Putin and Trump?
You can have as many meetings as you wish, but that's humiliating for the great power America is. I live in America, and I'm an American taxpayer, and I feel very badly for my country, new country, to be humiliated, because Putin uses that. He scores politically back home and in the eyes of China and other countries of the world, that he talks equally like an equal, being a war criminal. He is war criminal. When President Trump says that part of Ukraine had been obliterated, it's exactly right. But who did it? Who started all that? Putin. Putin can call the war back, just telling his troops to go back home to Russia. So what's the point of those empty talks? For Putin, it's political gain. For America, it's humiliation.
Andre, we got to leave it there. Thank you so much for joining us. Andre Kozyrev and also Patrick DeHaan with Gas Buddy. Appreciate it.
Thank you.
Coming up, we'll dive into the latest bullish call on gold, why one analyst sees the safe haven topping $3,000 this year. That's next on Catalysts. There's a new bullish call on Wall Street, with Goldman Sachs raising its year-end gold target to $3,100 an ounce. Yahoo Finance senior markets reporter Inez Ferre has the story. Hey, Inez.
Hey, Maddie. Yeah, and Goldman's prior target was $2,890 by the end of this year. The forecast now is, as you mentioned, $3,100, as demand from central banks is structurally higher. Central bank demand, led by China, will add 9% to the gold price by year end. And we saw last year all-time high levels for gold demand led by central banks. Well, Goldman analysts are also basing their predictions on an uptick in ETF buying. However, they do go on to say that if policy uncertainty, including tariff fears, stays high, then you could see speculative buying, sending the price of gold to $3,300 per troy ounce. And right now we're seeing gold prices at just above $2,944 per ounce. Goldman's base scenario, by the way, assumes that the Fed will cut rates 2 times this year. If the Fed funds rate stays flat, though, gold may come just shy of their price target. Year to date, you're seeing that gold futures are up more than 10%, guys.
We have seen that rapid move to the upside. All right, Inez, great stuff. Thanks so much.
Thank you.
Keep it right here. Wealth is coming up next, dedicated to all of your personal finance needs. Brad Smith has you for the next hour.
It's time for Yahoo Finance's Market Minute. Stocks mixed to kick off a holiday-shortened week. Nike shares getting a boost on news the company is partnering with Kim Kardashian's Skims. The endeavor, named Nike Skims, is the first time that Nike has joined with an existing outside company to create a new brand. New products expected to drop this spring. Intel is surging on reports that Broadcom and Taiwan Semiconductor are both weighing deals for parts of the struggling chipmaker. That's according to the Wall Street Journal. Broadcom is eyeing Intel's chip design and marketing business, while TSMC is considering its chip plants. And Medtronic shares sinking after missing revenue estimates driven by a decline in its medical surgical portfolio. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup, we'll break down passive investing and its connection to market concentration, aka talk about how passive investments, which are typically concentrated in big tech growth names, can reduce your diversification. And housing hurdles. We dive into your first-time home buyer checklist, 3 things you need to do before you start your search, and how to avoid the biggest mistakes that you can make. Plus, credit card balances are hitting another all-time high. The hosts of Yahoo Finance's Living Not So Fabulously join me to discuss 4 budgeting strategies to reduce your spending. All that and much more coming up during today's show. But first, we take a look at some of the market action. We're 90 minutes into the trading day. Stocks are mixed to kick off the holiday shortened trading week. Joining me now, we've got Andrew Graham, Jackson Square Capital Managing Partner. Great to have you here with us. According to the latest survey from the American Association of Individual Investors, bearishness is at the highest level since November of 2023. How should investors be navigating that?
Thank you, Brad. Thank you for having me on. Yeah, I think that's a contrarian indicator. Obviously, high levels of bearishness or elevated bearishness don't mean a ton until they get to extreme levels, and we're not quite there yet, but extreme levels of bearish sentiment on behalf of investors should be a bullish signal. It should be a reason to add exposure. So I don't think it's there yet. I think there's, we sort of feel like we're sitting in no man's land with regard to sentiment. I see there's a lot of length in the market, but I think that's expected considering that the growth data remains resilient and there's been a solid earnings growth in Q4.
And so with bearishness at those levels, where does it seem apt to add on that exposure that you were mentioning?
So it's tough to find, it's tough to find value in the market. You're trading at 21 times forward estimates. That's historically a high multiple. I think the Mag 7 names have underperformed year to date. They're up 2% year to date. The other 493 were up 4%. The fundamental reason for that, I think, is the spread on earnings growth, or at least expectations for earnings growth. So I think that group is probably going to underperform relative to others, and you got to find value elsewhere. For us, software looks like a place to be. So in December, we noticed the widest spread or the widest divergence between the performance of semiconductors and software stocks in history, and thought that at some point it's going to converge. And the reason for it to converge in our expectation was the AI inferencing phase would kick in. The DeepSeek news from a few weeks ago may have been that catalyst, and you saw some of those stocks start to outperform just coming out of that. So software is an area for us. Then we also find value in pharmaceutical stocks that have been held back, I think, by the RFK anxiety or whatever. And there's just a couple of names in there that we emphasize. So those are the 2 main areas.
Andrew, you also talked about and alluded to some of the macroeconomic scenario here, and that largely takes me to the mind of the consumer as we've been continuing to evaluate that in different inflation readings, retail sales data, all those things considered here. How are you looking at this week's retail earnings, getting a sense both of that macroeconomic backdrop, but also how investors should be playing some of these retail names?
Yeah, we like Home Depot in retailing. We think that the company is probably going to post better same-store sales than the street expects. That's one of the areas that we were where we want to be. We also saw an inflection in home sales in Q4, which is a welcome sign considering how long it's been in the doldrums. But yeah, we've got to make sure that the consumer stays in good shape for all this to work. Tariff risks potentially could hurt the lower income consumer that's already sort of reeling from 2.5 years of above trend inflation. And we've got to keep an eye on credit spreads as an indication of some potential risk there. But for us, within retail, we like Costco, which is the undisputed king of retail, and then Home Depot in here because we think the rest of the street's got it wrong.
What do you think that retail will need to say about some of the potential policy impacts on their businesses, and how are you going to be listening in for what those policy implications mean for other sectors of the market?
Yeah, so when you think of tariffs, maybe you think of retail as being the most impacted sector. They're going to pass, any plus tick in the cost of the goods off to the consumer. And so, yeah, it's a consideration. I'm not so sure, though, that's the biggest consideration. It's been held back so much. The retailing names have been held back. And I think that's where the opportunity lies because these stocks are relatively cheap compared to the rest of the market. But yeah, finding the right place is important, and I don't think you need to be getting too cute here. We'd stick with the leaders and the ones that are the best managed in Costco and Home Depot.
I got as cute as I can get for this show. Andrew, thanks so much for taking the time. Appreciate it.
Thank you. Thanks, Brad.
Certainly. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session. We've got Yahoo Finance's trending tickers page that it'll take you to. Joining me now, we've got my morning brief co-host, Shauna Smith, here live and living color on set. First up, we got to talk about Nike here, partnering with Skims, Kim Kardashian's shapewear company. They are forming Nike Skims brand, which will offer training apparel, footwear, and accessories. And they say that these are designed for the needs and preferences of women athletes. Products will start hitting shelves this spring. Shares are up by about 4% as investors, they are looking at the effect of the Kardashian engine, if you will, here, and what that's done for Skims in the past and perhaps this partnership.
Yeah, certainly. I think it's very, very smart of Nike. You're seeing that clearly reflected by the stock reaction here this morning. The power of Kim Kardashian herself, just as a marketer, the mass following that she has, also just a loyal customer base that Skims has quickly acquired here over recent years. So the fact that they are putting in a line together here between Skims and Nike does have the potential to really add to some of Nike's momentum that we know very much is a priority here for their new CEO, Elliott Hill. And remember, this also comes on the heels of that Super Bowl commercial we just saw about a week ago with the focus on female athletes. It is something that Nike has time and time again really put even more emphasis on in recent weeks, in recent quarters. So again, this is very much an extension of that priority that we have seen placed there from Nike. So the Nike Skims collection is going to debut in the spring, of course, in the global rollout coming after that in 2026. So I think this does have the potential to be a huge win here for the brand, which we know is very much in the midst of a turnaround process.
Yeah, this is major here, especially for all the points that you were just making. One additive one that comes to mind for me is that Nike and some of the other footwear and athletic apparel brands have really leveraged some of the individuals that have created brands for themselves and done collaboration efforts with them. But this, in a new brand in itself, really speaks volumes about how much they are confident in making sure that they can bring this to fruition and the long-standing power it could have too.
Yeah, and I also think it's a real athleisure play too, potentially. I mean, I haven't seen any of the mock-ups of what this could potentially look like, but when you talk about the loyal followings of a name like Aloe or Lululemon and that type of customer, just going beyond that typical or what maybe you would think of a Nike wear here when it comes to the female customer, when it comes to those who very much are playing sports, actively playing sports. When you do expand that customer base, you're able to unlock that value, which we know has been very, very critical and certainly successful for some of the other competitors out there. So certainly Nike then potentially could maybe win back some of that lost market share.
All right, we've come a long way and a huge step forward since the Kim Kardashian Skechers commercials that we've all seen in years past. All right, we'll continue to monitor that, plus a bullish call on Wall Street that we're keeping tabs on. Jefferies upgrading Wynn Resorts to buy from hold. Their new price target is $118, representing 33% upside as of the stock's last close. Shares are up right now by about 2.5% right now on this call.
Yeah, certainly it's a valuation call. They're very optimistic about the new location that will be about 50 minutes there from the center of Dubai, from Dubai's airport there. It's Wynn Al Marjan. they're saying that is a big reason, a critical reason here for this upgrade when it comes to valuation, where they're seeing that growth opportunity right now. They expect what has been a relative 8 to 9 times implied valuation there. They're seeing further upside to that 11 times EBITDA. So again, when you talk about the fact that their new price target is now $118 a share, they also talk about the fact that that VIP premium consumer, this will enable them, give them a little bit more exposure to that as we do see the recovery in Macau take time. So again, buying them a little bit more time and a return there to that lost growth story.
Yeah, Macau, they're expecting stability in 2025 on macro and market. Preliminary results positive at the tail end. They mention full hotel occupancy, solid VIP turnover, to your point, and then largely as well here for the domestic front, improved expectations for Wynn Las Vegas here. I don't know if you got any trips planned to Wynn Las Vegas.
I wish.
Oh yeah, well, you and me both. Shauna, thanks so much for taking the time. According to Bank of America, passive investing dominates global markets, a combined $22.5 trillion in ETFs and mutual funds. We're going to talk more about this on the other side of this short break. According to Bank of America, passive investing dominates global markets with a combined $22.5 trillion in ETFs and mutual funds. But the firm says passive investing represents a potential risk potentially as well here. Since most ETFs and mutual funds are market cap weighted, those investors are putting a lot of money into some of the biggest names. Think Mag 7 names like Apple, Nvidia, and Microsoft. And putting so much market share behind those big names reduces diversification. Here to explain and tell you what you can do about it, we've got Jared Woodard, who is the head of the Research Investment Committee and ETF Strategy at Bank of America. Jared, good to have you back on the program with us. First here, almost every person watching is probably invested passively in some of the biggest names on the street. So how can that present a risk to the market?
Thanks, I'm glad to be with you. And it's a great question because this is such a crucial time. You've just passed a major inflection point in the equity market. Now, at this moment, more than 50%, I think it's about 54% in total of equity funds are invested in passive products that track passive indexes, which means all that money is allocated to strategies that will continue to buy the market without any strong connection to valuation or to earnings or to other fundamentals. If you think about the typical model of an equity market, what makes markets so efficient? Well, part of that efficiency comes from the discipline imposed by active investors, people who are seeking out good value opportunities, avoiding stocks that might be too expensive. That active process of seeking out new opportunities has delivered incredible returns in equity markets over the long term. The challenge today is that, from our perspective, the flood of money that's come into passive products, now dominating the lion's share of the market, is so disconnected from fundamentals that it does make investors less diversified than they've ever been before. It poses risks.
Jared, I think we lost your mic. We're going to get the audio fixed just a second here. While we are taking a look at Jared's audio, let's just take a quick look at the markets here. As we are nearly 2 hours into the start of today's trading activity, we were mixed a moment ago. We are continuing to be mixed right now. The Dow is lower by about 0.1%. The S&P 500 holding on to gains of about 0.1%. And the Nasdaq Composite flat, just barely to the upside right now. We will return to that conversation when we get the chance here. But switching gears, worries over high housing costs, mortgage rates, and tariff impacts weighed on builder sentiment during February, pushing the index down to its lowest level in 5 months. Here to break down the latest report, we've got Yahoo Finance's Danny Romero. Hey, Danny.
Brad, home builders are feeling less optimistic about the housing market as they navigate over tariffs, high housing costs, and high mortgage rates. The National Association of Home Builders, they reported that their index fell 5 points to 42, and that's the lowest in 5 months. Now, remember, any reading under 50 indicates that builders view conditions poor than good. Now, one of the major cost concerns here for builders stems from President Trump's executive order to impose 25% tariff on all imported steel and aluminum products, and that will take effect in March. And so according to the National Association of Home Builders, they're expecting that these tariffs will increase residential construction costs, which is a major headwind for them because they are still dealing with elevated mortgage rates. Mortgage rates are still hovering around that 7%, which is dampening demand. Also, an economist from the National Association of Home Builders says that they're expecting incentives to really weaken over the next few months because they're expecting that affordability will still be constrained. Brad?
Denny, while we have you, there's a new report out from Realtor.com about the state of the rental market. What can you tell us there?
Brad, renting is still more affordable than buying a home. And there's only 2 metros in the US that are more affordable if you are thinking about buying a home. And that's Detroit, Michigan, that's Pittsburgh, Pennsylvania. And the reasons why is that both cities have the lowest median listing price for a home, and that's around $230,000. So renters are still feeling the impacts of the rapid rent growth that happened in 2021 and in 2022. So for some context, rent in January last month was $257 higher than it was in January 2020. That's according to Realtor.com's data. Now, there are only 3 metros in the US that are becoming less renter and buyer friendly, and that's New York, San Jose, California, and Detroit, Michigan. And that's because it requires more income, whether you are looking to rent or to buy a home.
Danny, thanks so much for breaking these down for us. Appreciate it. Well, there is a lot of uncertainty in today's housing market with rates hovering just under 7%, home prices remaining high and continuing to grow, plus the potential impact from new policies under President Donald Trump. So this week, we want to ease the fears of potential home buyers by getting some key tips and tricks from real estate experts. Today, it's all about the first-time home buyer. And joining me now, we've got Jennifer Beeston, who is the Senior Vice President of Lending at Rate.com. Great to have you here with us on the program. First, we got to talk about the two biggest mistakes that you're seeing first-time home buyers make. What are they?
So the two biggest mistakes are they just jump in. You know, they go, I want to buy a house, and they start looking at houses. You really need to make sure you're doing a budget and you know what you can afford before you jump in. The second biggest mistake is they are not vetting experts. So they're just going with, oh, I met this person at an open house. They're nice. Oh, they told me to use this lender. And that can really affect what you pay for the house as well as your experience. Those are the two biggest mistakes I consistently see across America.
Okay, and so what are the things that people should do before they start looking for houses?
Number one, sit down and take the time to really dream about what this house is. Why are you buying it? Are you buying it because you want acreage to grow your own food? Is it to stay in a school district? What is your main driver? Start there because that's going to be your touchstone. The next thing is, how much can you comfortably afford to pay? And that's going to be for your principal, your interest, your mortgage insurance, if you have it, property taxes and insurance, and then do a budget. And lastly, get a fully underwritten pre-approval from a lender and make sure you're working with someone that's going to ask you the tough questions like, hey, your debt to income's really high here. Are you sure you can afford this? You know, really having those conversations is so key.
Absolutely. And so for the first-time home buyers that are out there, before they perhaps go even see homes, what are your three tips for those first-time home buyers?
So my three tips when people are starting to look at shopping for houses after they've gone through that pre-approval and they've picked their A-team is going to be, first of all, avoid tech fatigue. That is a real thing. Realtor.com, Zillow, Homes, all of it. You can spend hundreds and hundreds of hours on it. And all it does is it gets you to a point where you want to give up. So figure out what you want, circle the area, sign up for alerts, only look at that. The next thing is, before you go and look at those houses, play detective. I love that. It's so much fun. It's something I do with my clients. Look at the pictures, look for any potential problems, because when you're going through a house, you usually go fast. It's someone else's house. You're not going to be as comfortable. You know, check it out on Google Earth. Google Earth is something everybody should be exploring because I've seen Google Earth really save some home buyers from making some big mistakes, like buying a house on a train track if they don't like noise. And thirdly, get a homeowner's insurance quote. The unfortunate reality of 2025 is that homeowners insurance across America has soared, and it can really make home ownership unaffordable. So we really want to make sure you're going to be in that range before you start shopping.
Yeah, love trains, grew up playing with Thomas the Tank Engine, but wouldn't want to live right next to the track here. Sounds a little disruptive for sleep. You know, just lastly, while we have you, one of the things that you mentioned a moment ago, insurability of your home. What is the calculus that homeowners and potential buyers should be taking into account when they're looking at properties about the insurability of that home?
That's a great question, and it's something every home buyer should be considering right now. What I need to tell you is that if you go to the big websites, we're all on them. I live on Zillow, right? The insurance quotes are wrong. So it's like what I advise to buyers is find a house that you like, call an insurance company and say, hey, I'm thinking about writing an offer on this house, but I need to make sure it fits within my budget. The reason I say this is there's parts of Florida, for example, where a $400,000 house, the insurance will be $15,000 a year. But if they buy a different house, it may be less. Do I have concerns about insurability overall? Long-term, yes, in certain portions of the country. At this point, we're still seeing homes get insurance, but it's definitely getting more expensive every day, and it's something I'm very cognizant of.
Jennifer Beeston, thanks so much for taking the time here with us on Yahoo Finance. Good to see you again.
Good to see you.
Coming up, Doge continues to seek more information from U.S. government agencies. We'll discuss how one request pushed a top official to leave their job. Plus, it's tax season. We'll take you through some of the terminology that you need to know. Stay tuned. Let's get you a check of the markets. We are 2 hours into today's trading activity. The Dow Jones Industrial Average down right now by about 0.2%. The Nasdaq Composite, that is just barely holding on to gains by the hair of its chinny chin chin. It did cross into negative territory early in today's session. We have seen some hyper waffling though for the tech heavy average. Let's also take a look at the S&P 500. That too has touched both sides of the trade, both red and green today. It is positive right now by about 0.1%. We'll be generous and round that off too. Let's see what's happening under the hood with today's trading session. I'll get back to the Nasdaq 100, but taking a look at the 11 S&P 500 sectors, you've got energy leading the pack right now. That's up by about 0.9%. Pulling up the caboose, though, you've got consumer discretionary lower by about 0.5% at this point. You've got more gainers than laggards right now. And so going underneath of the trade for tech right now, Nvidia, they report earnings next week. You're taking a look at shares right now, up by about 1.7%. Apple and some of the other mega cap tech stocks, a little bit mixed right now here. Meta, this is the one that you should be focusing in on. It's been a record run that we've seen for Meta platforms here that we've been tracking. However, today it's down by about 2%. We'll see if it can claw back some of those deep declines that it's in right now here, just a shade off from some of that lake red and maroon red, if you will. That can't be said, though, for Autodesk. That is in maroon red. It's down by about 3.5% here on the day. And then just lastly, let's ride out with a look at the Dow 30 components here and now. As Luther Vandross would say, you are seeing a mixed picture. I'll put this on equal just so you can see what type of split we're looking at here. United Healthcare pulling up the caboose right now. That's down by about 3%. Nike leading the pack. Big partnership there with Skims. That is pushing shares higher by about 4.5%. We'll continue to watch all this activity as we move on throughout the rest of today's trading session. Well, the acting commissioner of the Social Security Administration was replaced over the weekend after apparently clashing with Elon Musk's Doge over access to sensitive information. Yahoo Finance Washington correspondent Ben Werschel has the story. Hey, Ben.
Hey, Brad. Yeah, so a lot of changes this weekend at the Social Security Administration. Michelle King is the name of the was the former acting head of the agency. She was a career official there, and she's now been replaced by one of her deputies in what was apparently a clash over Trump appointees getting access to the Social Security's sort of core data things. Social Security, of course, not just your Social Security number, it's medical histories, it's earnings history, it's a lot of data on Americans. And that's the clash. This is sort of Musk's latest move as he kind of goes through Washington and all the federal agencies. It's a pattern here where he sort of seeks access that's pretty of all facets of American of these government agencies. But this, of course, Social Security, of course, represents the largest line item in the federal budget. It's a huge program that gives out over $1.3 trillion a year. What Musk and his folks say is this is about eliminating fraud. This is about what they claim are checks that are going out wrongly to either illegal immigrants or, as they say, 150-year-olds. There's a lot of questions on how big those are. A big Musk critic I spoke to this morning, she says she's in touch with current officials, and Musk currently has access, in her words, access to everything, so everything that can. And this is more, she's likened it more as a fishing expedition to kind of get through this and sort of get through the data that the government has. Either way, it's a sort of a setting up a major clash, and there's been a lot of lawsuits on Musk as he's gone through this. We'll surely see that in the days ahead.
Ben, thanks so much. Really appreciate the breakdown and tracking the story as it continues to develop.
Mm-hmm.
We are a little under 2 months away from the tax deadline of Tuesday, April 15th, and we want to help you on your journey to file by breaking down a couple key terms. Here to help me out, we've got Andrew Gordon, partner at Gordon Law. Andrew, good to have you back on the program. There are two big components of taxes that can either lower the amount of tax you owe or lower your income, thereby lowering your taxes. Let's start with lowering your income, which is a deduction. Define a tax deduction for us and talk about how it helps.
Yeah, thank you very much, Brad. It's great to be here. And although tax deductions and tax credits, people often use these terms interchangeably, they're actually very different. And knowing how to utilize these can mean more money in your pocket, greater refund come tax time. And so the first to be aware of are tax deductions. Tax deductions reduce your ordinary income. And so, for instance, if you're an individual, you can choose between the standard deduction or itemizing your deductions. And as an individual, for someone filing individually, that's $14,600, or filing joint, that's $29,200. But if you itemize, it depends on your actual expenses that you incurred during the year. So it could be much greater than the standard amount.
So what are some of the examples of common deductions?
Yeah, Brad. So some of the most common ones, for instance, are charitable deductions that you incurred during the year. So if you had donated to a charity, make sure you get those receipts before tax time. We're only a couple months away, and a lot of people scramble before that deadline. But make sure you start preparing now and getting those receipts handy. The next is medical expenses. Now, there's a threshold that you must hit before you can start taking medical expenses, but this is another great one. Also, if you own your home and you pay a mortgage, you can take a deduction for your mortgage interest paid. The banks will typically send a tax form, so make sure you get that tax form and keep it handy for your accountant. And the last one, but perhaps one of the largest, is for state and local taxes. For those of you out here that are in a high tax state, places like California or even New York, you can get a deduction for the taxes that you pay in your state.
So let's move on to tax credits. What are those and how do they work?
Yeah, so again, it sounds like a similar word, deductions and credits, but they work very differently. While deductions reduce your income, tax credits reduce your actual taxes. They are a dollar for dollar deduction against the taxes paid, not your income. And so your income applies a tax rate to it when determining your taxes. But if you have a tax credit, you can actually take that dollar for dollar against the taxes paid.
And so can you give us here some examples of tax credits?
Yeah, one of the most common is education credits. So if you're attending college or if you have a dependent that's attending college, there's actually 2 different education credits that are available. And it's possible to maximize one over the other. So talk to your accountant, or if you're self-preparing, make sure you look at both of these education credits. The next one is the child tax credit. The federal government will actually give you a credit for having kids. And so while they may be more expensive, there are some benefits as well. The other one to be aware of is electric vehicle credits. So while it's nice to have a new car, you'll also get a tax credit at the end of the year as well. But you need to make sure that you keep all of your receipts, keep the invoices so that you can support that credit come tax time. And the last one to be aware of is that if you made home improvements, specifically energy efficient home improvements, these also act as credits against your taxes.
Does my e-bike count as an electric vehicle? Perhaps that's too into the weeds here. But look, it's realistic for a lot of people who might be, in the gig economy and delivering for DoorDash or delivering for Uber Eats and whatnot.
That's a great question. And the federal government actually has specific requirements on the type of vehicle for the credit. So my guess is probably not.
All right. Thanks for entertaining the question nonetheless. Finally, let's help our viewers hack the system a bit here, making sure that they are being as efficient as possible when trying to save a buck or two. What's a tax loophole that people you've seen use to save money?
So, Brett, I'll tell you one of the best ones, and you don't actually even have to pay me for this, and that's tax loss harvesting. And you can do this at any time during the year. If you're invested in stocks or any property and you're going to have a gain at the end of the year and pay taxes on it, you can sell other property, other stocks, and realize losses to offset those gains. But the big loophole here that a lot of people don't know is that you can sell a stock at a loss and buy a similar one right away and still have that loss. So for example, maybe you sell Coca-Cola and then you buy Pepsi the next day and you can still have that loss.
All right. Not advice, of course, from us, but of course on the loophole, a good spotlight on that. Andrew, thanks so much for taking the time. Great to see you.
Thank you.
Coming up, everyone, my conversation with the Operation Hope founder, chairman, and CEO, John Hope Bryant. Stay tuned. This Black History Month, we're celebrating the power brokers in business, executives, entrepreneurs, and proven change makers who have advanced the economy and society. I spoke with John Hope Bryant, the founder and CEO of Operation Hope and the author of the book Financial Literacy for All, about the importance of financial literacy and how education is critical to AI-proofing your career. Listen.
What we need is to reconnect education in the aspiration. So financial literacy and artificial intelligence, because AI is going to change everything and money is everywhere. These two things have to be fundamental. You shouldn't graduate from high school without a financial literacy degree and an AI certification. In Atlanta, every kid in Atlanta public schools has a Hope Child Savings Account in kindergarten. Statistics show if you have an account with $100 in it, you're 75% more likely to graduate from college. We're doing that for every kid in Atlanta public schools. That Citigroup holds the accounts, Mayor Andre Dickens funds the accounts, private sector supports it, and then they come in and volunteer, giving the kids now a role model who they can be. They're talking about stocks and investment. That should be in every community in America. That's that. Then we have the AI LP3, which is Sam Altman of OpenAI, and I co-chair the AI Ethics Council. We've created a pipeline through Prosperity Project with all the HBCUs. Georgia State University is our partner, Atlanta Public Schools, to teach artificial intelligence and to nurture these kids in creating new jobs and the innovations of the future from kindergarten through. They're already on the device. They're already on their devices. They're already technologically centric. Why wait for AI to destroy jobs? It's coming. Let's get kids to create the new era of jobs. So that's happening with AI LP3. We just announced that in Atlanta. This sort of out of the box, innovative thinking needs to be scaled across the country. Financial literacy is a civil rights issue of this generation. Should be in every school, urban and rural, black and white, rich and poor, all across the country.
With that in mind, how do you go about AI proofing your career trajectory as well?
Well, look, the world went from 1850 to 1910, horse and buggy, to the automobile. One out of 10 jobs in 1850, 1870, 1880 was a I think it's called a farrier. They were basically changing shoe hoofs. By 1910, that whole thing was gone. Horses were gone. Automobiles took over. We're there again, but it's now 2023 to 2030. Everything's going to change. So either AI runs you over or you run it. We need to now train, so 75 million jobs will go away, 88 million jobs will get created. But you got to reorient yourself to master the technology that will be driving AI versus letting AI drive you out of a job. If you have a high school education right now and no hustle, you're in trouble. Go to the airport, the grocery store, not the grocery store, the fast food restaurants. I don't want to name the ones in particular for your show, but it's a pad. You're punching in your order. That used to be people. It used to be 12 people behind the counter. Now it's 2. Right? All that's being automated, and there's robotics on the other side. It's already here. So you got to future-proof yourself through becoming massively educated.
I also asked John about getting a portfolio started in this bull market and his investment advice. Go for fundamentals and don't overcomplicate it. Here's what he had to say.
You like Under Armour. You wear Under Armour. Buy Under Armour. You like Nike shoes. You like Walmart. You like Target. You like Delta. Buy that stock. If you like it, your friends probably like it, the market probably likes it, it's probably a good investment. Buy fundamentals, buy the basics, buy the framework, the thing that is the architecture for the biggest economy in the world. Don't get fancy. There are 3 things that have never reversed in American history. Real estate values, stock market values, and American GDP. It's never gone down. It goes up, there's a recession, it recedes, and corrects above the line. So financial literacy tells you buy it, hold it, buy fundamentals, hold it, don't sell. What people do is they buy it, sometimes they buy flaky stuff, by the way, because they want to get rich quick. Get scared, sell it, which makes things worse, right? And then somebody else buys on the dip. So I think buy fundamentals. Of course, I love real estate, you know that. And I'm the largest minority owner of single-family real estate in America, rentals. and I'm about to buy more. I'm about to go into multifamily, and this is the business side of me. So I just believe in this country. I believe it is the bright light and the North Star for the world economy. It is the gold standard, if you will, for it is the best currency, it is the best economy. And if you buy here near economic activity, you're going to do fairly well.
John, we got to leave things there. Just quickly though, what's the market that you want to buy in right now? You mentioned your real estate holdings. What's the next hot spot?
I mean, look, if you're smart about it, it's technology. I mean, you can't. It's all around you. If your life's not centered in technology, you're not sitting still. You're going backwards.
Sure. So
Dr. King had this great quote in the '60s: "The world is moving at jet-like speed, but we're moving at a horse and buggy pace." That he was talking about social justice. By the way, and someone would argue we're at that inflection point again. Yeah. But I think if you understand that today we've gone from a discussion in the streets to a discussion in the suites. The color's not black or brown race, black or white race, or white or red or blue politics. It's really green. So it's economics. And what does the future look like? Well, a third of this economy is healthcare. A third, give or take, is finance. A good chunk of it's real estate. Technology is like the grease flowing through all those gears. So I think if you can look toward the future and believe in it, and then say, where would I like to see myself in it? That then gives you some sense of where I think you want to put your bucket down and invest. At least that's what I'm doing.
Coming up, we're breaking down a few budgeting strategies that you might want to try. That's next on Wealth. A programming note, in this week's special episode of Decoding Retirement, host Bob Powell is joined by Steph Guild, Robinhood's Senior Director of Investment Strategy. Guild discusses the role of bonds in your portfolio.
I do think we're in a paradigm shift where bonds aren't necessarily playing the role that they did for the last 40 or 50 years. Because if you look, since 1982, interest rates have only dropped. So it's really been a consistent place. Interest rates, if they fall, the value of bonds go up, and vice versa. We've been in a period where interest rates have risen and they've been pretty sticky. And there's a lot of reasons for that. You know, government deficit being one. So I'm not sure that bonds are going to play as stable of a role, which is why I'm saying, like, you know, really think about your risk tolerance, and it doesn't necessarily have to just be based on that age formula.
You can catch episodes of Decoding Retirement Tuesdays, 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. According to the New York Federal Reserve, U.S. credit card debt hit a record $1.2 trillion in the fourth quarter of 2024. Over 7% of those balances transitioned into delinquency over the course of the full year. And if you're one of the consumers with outstanding debt, making a budget that you can stick to, it is paramount. Joining us now with a few options for different budgeting strategies, we've got John and David Altenschneider, who are the debt-free guys and hosts of the podcast Living Not So Fabulously. Great to have you back here in studio with us. John, let's start with the no budget budget. How does this work?
Sure thing. Thank you for having us back. The no budget budget is great for those who don't want to micromanage their expenses. Essentially, you come up with 3 buckets. The first is for your investments and your savings. So you can say every month, I'm going to put 20% toward that. The middle bucket covers all your musts. So all of your expenses, your bills, mortgage, insurance, groceries, etc. And then everything that's left over, you can spend without stress and without shame. It's great for those who want to be a little bit more flexible with their spending, and after a series of months, you'll realize how much fun money you have for month to month.
Okay, so David, break down the 50-30-20 budget for us here.
Yeah, similarly to all the other budgets, this is really breaking things down into buckets, but these are really high-level buckets. So 50% is set aside for your needs, and needs cover things like your mortgage, your insurance, your car payment, those kinds of things, even credit cards. The 30% is for your wants. This is the money I want to have, enjoy my life. That's the fun money.
Oh yeah.
Yeah, and then the 20% is set aside for either paying off your debt, especially that high interest rate credit card debt, or saving for the future. And so because you bucket these in large, big buckets, you have a lot of flexibility with where you're actually spending that money.
Yeah, sounds like paying down debt needs a better marketing team, because that's pretty fun too here. John, what is the zero-based budget?
Zero-based budget is good for those who want to or need to micromanage their expenses. Basically, what you're doing is you're assigning a job to every single dollar. So get crystal clear on what your expenses are, know exactly where every money is going to go every month, know exactly what your income is from all your jobs, your side gigs, your investments, and then essentially figure out where every dollar is going to go from month to month so that you zero out your budget from month to month. It's also great for those who like to use spreadsheets and also like to use budgeting apps.
Yeah, big fan of spreadsheets here for sure. Perhaps there are a few apps that I should try out though. Yeah. David, what is the pay yourself first budget? Because I feel like I do this maybe too much.
Yeah. Well, what's interesting is there's a lot of confusion or maybe misplacement around this idea of pay yourself first, because many people think pay yourself is take care of yourself first. What pay yourself really focuses on, and we talk about this in our 5 Freedoms Accelerator program, that really is focusing on paying your future self first. We really say that pay yourself is broken down into 3 pieces. Pay your future self first by investing and saving for the things that you need and want. Pay your past self second. That's for all the expenses that you've already acquired. So that's your mortgage, your car payment, things that you've already bought. And then your third one is taking care of your present self. And more often than not, that is the fun money. And also, that's more often than not what we focus on when we think we're paying ourselves first.
Yeah, all right. Well, that felt like a personal attack, but it's still a good strategy here. John and David, thanks so much for taking the time here in studio. And you viewers at home and listeners, you can catch new episodes of Living Not So Fabulously Wednesdays at noon. Let's do a final check of the markets here as we're approaching lunchtime, Eastern time at least here. Not sure which time you guys do it on the West Coast, but hey, to each their own. Taking a look at the major averages, the Dow right now, it's down by about 0.1%. S&P 500, though, holding on to gains of about 0.1%, and the Nasdaq Composite flat, but to the upside here. All focus might be on Meta here on the day to see if that streak can continue or if this is it. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. Stay tuned for Market Domination coming up 3 p.m. Eastern Time.
It's time for Yahoo Finance's Market Minute. The stocks are mixed as the S&P hovers near record highs. Nvidia bucking the downward trend in tech today, now leading Mag 7 gains. Shares are off the highs of the session, but still up just about 1%. On the flip side, Meta is on track to snap its record 20-day win streak, with shares down just over 2%. Baidu is falling as weakness in advertising demand and sliding revenue weigh on the stock. But AI helping the Chinese tech giant offset some of those losses. Revenue in its cloud division jumping 26%. And Walgreens shares surging on a CNBC report that a deal to take the drugstore private could be back on the table. This comes as the company faces a number of challenges, and those include falling drug reimbursements and increased competition. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.